Hey everyone, welcome back to Corporate Decoder, the place where we unravel the financial mysteries of big companies and leave you with the juicy details right side up. What do you think happens when a bank that has been around since the 70s starts selling off branches and changing up its lending strategy? I have a feeling it is going to be quite the financial roller coaster before we dive in. If you love getting clear, no fluff insights from company filings, make sure you hit that subscribe button and ring the bell so you don't miss our deep dives. We also have a growing community on Discord linked in the description below where we break down these reports together. Alright gang, today we are dissecting the 2025 annual report from First Interstate Bank System Incorporated, or as they are more commonly known, FIPT-HAG. This filing is like the ultimate yearly report card for the company, giving us the inside scoop on their financial health, their risks, and their game plan for the future. So who exactly is First Interstate Bank System? They are essentially a big bank holding company focused on community banking with operations spread across 12 states like Montana, Wyoming, and Colorado. They like to emphasize their deep roots in serving local communities and building lasting relationships. Think of them as a friendly neighborhood bank that has grown up and expanded its reach. Now let's get to the numbers, the part that really tells the story revenue wise. We are looking at a significant jump in non-interest income, up a whopping $55.3 million compared to the previous year. Primarily this surge is thanks to a huge gain of $62.7 million from selling off their branches in Arizona and Kansas back in October. That is a massive chunk of change they also saw. Growth in wealth management and service charges on deposit accounts, which is good, but the payment services revenue took a hit mainly because they outsourced their consumer credit card business mid-year, so they are retooling things, streamlining some areas while exiting others. And all this activity translates into fantastic net income, a cool $302.1 million. That is a 33.7% increase from the year before that gain. From selling those branches really boosted the bottom line, and get this, their provision for credit losses went down and FDIC insurance assessment rates, which is a double win for profitability. Things are looking up financially. Speaking for FIPT-HAG in 2025. But hold on a second, let us not get too carried away with the good news. The allowance for credit losses on loans actually decreased from $204.1 million to $191.4 million. This might seem good on the surface, meaning they expect fewer losses, but it also reflects a slight decrease in their overall loan portfolio, which the report attributes to things like selling off branches and exiting certain loan types. It means they are actively shrinking parts of their business, which can be strategic, but also signals a shift away from traditional growth avenues. Looking at their loan portfolio, it has shrunk by nearly 15%. It seems they are pulling back from certain lending areas, like ending their indirect loan origination in early 2025 and outsourcing their consumer credit card portfolio to focus on what they call more relationship-driven organic growth. They are essentially cleaning up their act and focusing on what they believe are their core strengths. Now about those tricky assets, non-performing loans and other real estate owned or OREO for 2025, these altogether came in lower at $138.3 million compared to $145.6 million in 2024. That is a positive sign, suggesting they are managing their risky assets a bit better. There is a notable chunk of non-accrual loans that are well secured by collateral, which is a good sign, but it still reflects loans that are not performing as planned. The overall provision for credit losses also dropped significantly from $67.8 million in 2024 to $26.8 million in 2025. This aligns with the shrinking loan portfolio and the strategic exits. But it is worth watching if this trend continues and indicates a real improvement in credit quality or just a result of less lending overall. Digging into the risks they are facing, FIC acknowledges the intense competition in the banking world, from traditional rivals to newer fintech companies. Some of these competitors have deeper pockets and can offer services they simply can't match. They are trying to stay competitive by investing in technology and enhancing their customer experience across digital and physical channels, but it is a constant battle for market share. And speaking of risks, cybersecurity still looms large. They mention increasing cyber attacks like business email compromises and network intrusions that could lead to spoiled information and significant financial trouble. They are taking steps to protect themselves with training and oversight. But in today's world, this is a never-ending arms race. On the strategy front, they are not just selling off branches, they are also reorganizing internally, moving from a layered regional structure to a flatter model. The goal is to speed up local decision making and better align with their relationship-driven growth strategy. They have even hired new state presidents to lead this charge. It sounds like like a big shake-up aimed at making them more agile and responsive. They also talk about investing in technology and development programs for their employees, aiming to foster a strong culture and keep their people engaged. This is crucial, because in the banking world, talent is everything. They highlight their commitment to community involvement, and even offer programs like student debt repayment, which is a nice touch. Now, looking at their overall financial picture, total assets have seen a dip of about 8.6% down to $26.6 billion. This is largely due to those branch sales and a decrease in their investment securities portfolio. The good news is that their stockholders' equity has actually increased by about 4.3% to $3.4 billion, this suggests. They are managing their capital well, and that any money generated from asset sales is being reinvested or used to strengthen their balance sheet. When it comes to market risks, interest rate changes are still a big factor. They are trying to manage this through asset liability management, and they do use some derivatives like interest rate swaps, but currently have no active cash flow hedges designated. This is something to keep an eye on, as interest rate shifts can really impact a bank's profitability. So what is my take on First Interstate Bank System? Well, they are clearly in a period of strategic adjustment. They are shedding non-core assets like those branches and consumer credit cards to refocus on their core community banking and relationship driven growth. What is interesting is that despite shrinking certain parts of their business, their net income and book value are up. This implies a more focused and potentially more profitable operation. Going forward, the risks are definitely there, especially with cybersecurity and the ever-changing regulatory landscape, but they seem to be actively managing their move to a flatter organizational structure and investment in employee development are smart moves for a company trying to foster strong local relationships. Their financial performance in 2025 was solid, boosted by a major sale, but the real test will be how well they execute this strategy of focused organic growth and whether they can maintain profitability without always relying on big one off gains from selling assets. Alright, that is our decode of the First Interstate Bank System 2025 annual report. What do you think about their strategic shift and their financial performance? Are they on the right track, or is there more to uncover? Let us know your thoughts in the comments below. And if you found this breakdown helpful, please give this video a like and subscribe for more corporate deep dives we love bringing you these insights. Don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching, and we will see you in the next episode of Corporate Decoder.